Welcome to Investing 101. This is really geared toward people that have absolutely no experience. So if you have no experience, don't worry, you are in the right place. Also, if you do have experience, if you traded some stocks before, if you know a little bit about investing and that kind of thing, don't worry as well. You are still in the right place. I promise I will fill you in on some information that you probably didn't know that you're going to see as valuable. So this course is Investing 101. We're going to talk about becoming a more intelligent investor, okay? I do want to let everybody know as we get started, I'm not giving this presentation as a financial advisor. Okay, so this presentation is for educational purposes. Please don't construe any of the information inside of the presentation as investment advice. Also, you should know that the stock market does have risk. You should do your own due diligence. Some people can and do lose money trading stocks, options, other investments. And you should also know that past performance is no guarantee of future performance, okay? This presentation is brought to you by the Smart Foundation for Financial Literacy. We are a nonprofit organization designed to help people just like you make smarter investment decisions, all right? So as we get started, chapter 1, introduction. Who am I? Why should you listen to me? Let me kind of fill you in on a little bit of that. So most of you know me, and maybe you don't, and that's okay too. My name is Michelle Mascio. I want to thank you again for checking in and to watch this video with me. I want to start by sharing some quick information about me, right? I started trading way back in 1997. At that time, I was 24 years old. A friend of mine, David, he told me how he was trading commodity futures and options, you know, like currencies and pork bellies and gold and that kind of stuff. Now, at that time, I had no idea what commodities were. Heck, I didn't even know what a stock was. I did not grow up like that, right? I grew up kind of like in a middle-class neighborhood, Waterbury, Connecticut. My dad was a traveling salesman. My mom was kind of mostly a housewife. I guess we just kind of lived middle class, and they didn't trade stocks, so they didn't tell me about it. And we didn't even go on vacations. Heck, I didn't even do any of that stuff until I was like way older and paid for it myself. So my friend David, he was talking to me back in 1997. He was telling me how he would look at some charts, he would put a trade in, and how he would make like $1,000 on a trade or something like that. And he didn't have to go to work or anything. I was hooked. I didn't know anything about any of this, like this world at all. I never knew you could make money like that, right? I just always thought like, to make more money, you had to get a better job or work more hours or something like that. But you know what? That totally was not true. So over the years, I traded for myself. And then back in 2007, I started trading for investors, for clients. I became securities registered. This year, I decided to focus all my time on education. So what I'm doing now is I'm strictly helping and teaching people like you. I like teaching. I think I'm good at it. And I feel like everybody needs to know this information, whether you invest on your own and even if you pay somebody else to invest. So here's the thing, people. If you're paying somebody else to invest, you still have to know some of this information, because how do you know if they're doing a good job for you if you don't know what any of this stuff is, right? So you have to know a little bit about the people, about the subjects regarding the people that you hire. So that's important. My commitment to you, now I know that time is everybody's most valuable asset, right? So I want to have a couple of commitments to you. So number one, I want to let you know that this information is geared toward beginners and as well as experienced people in investing. I said that early on. So even if you don't know what any investments are and you want to start from somewhere, you are in the right place. And if you've been around the block, you're still in the right place. I'm going to give you guys the Cliff Notes version of the material that we're going to cover today. So I truly believe that things can be as complicated as you make them or as easy as you make them. And I'm here to make it easy to understand. I'm not going to give you a lot of lingo. I'm going to keep everything in regular plain English to help you understand as we go. And I'm going to show you examples as we go as well. So I do also want to let you know that I'm going to use examples during the course. So I'm going to talk about different companies, But I do want to let you know that I'm not incentivized at all, zero, on whether you use any of these companies or not. I'm not paid in any way. I'm just using examples to help you understand the content better as we go along. Okay. So let's start with chapter 2. Let's dive right in. Ways to invest your money. I want to talk about different investments that are out there, and that way you can understand better on how to achieve your investment objectives within the risk that you are comfortable taking. Now, it's really important to understand that the best focus is on making money and not losing money. I think Warren Buffett said it best when he said rule number 1 is don't lose money. And he also said rule number 2 is refer back to rule number 1. That's how important it is, right? I personally always say that it's super easy to make money and more challenging to keep it. So that's important. In fact, oftentimes people don't think enough about risk. Here is a mathematical fact. If you lose 50% of your money, you don't need 50% to get back to even. You actually need 100% to get back to where you started, right? So if you lose 50% of your account value, you need to make 100% just to get back to where you started. Now that's a big return. So I want to help you guys understand how you can minimize risk and not lose money, or minimize the chance of losing money, right? So in this chapter, we're going to talk about the different investments that are available to people, and I'm going to go over how they work. So obviously, starting with like maybe the most conservative investment type is cash, right? Cash is king. Cash is probably kind of obvious. It's green cash money, right? So everyone should have some cash laying around in case an emergency pops up. I don't say rainy day because I don't want you wishing for a rainy day. I just say that everybody needs some emergency money, right? You can keep cash under your mattress, right? Or you can keep cash in an account. You can keep it in a checking account or a savings account. Now, a checking account is a cash account that typically you can write checks against, right? You usually also get a debit card with a checking account, and you can spend against the money that you have in that account, right? A savings account is a cash account that you don't typically write checks against. Usually money in a savings account is just like rainy day kind of money, right? Really, really emergency kind of money. Sometimes you get a debit card for a savings account, but usually you have to go to the bank in order to take your cash out. Now, both checking and savings accounts are typically held at a bank or a credit union, but there are also online checking and savings accounts as well. Most of these accounts are going to be what's called FDIC insured. And you can specifically check if your bank is FDIC insured through this website here, www.fdic.gov, right? FDIC insurance is also called deposit insurance, and it's free. It comes standard with most banks and most credit unions. And what it means is that if the bank ever goes out of business, your money is insured and you're not going to lose any of it. That's what that means. There are limits though, and sometimes these limits change. So from time to time, you're going to want to reference the website that I mentioned here to see what those limits are. Right now, today, the limit is $250K per person, per bank, for each ownership type account. What that means is you have up to $250,000, all of which will be insured. And you can have this amount at different banks. You can have $250K at Bank of America. You can have $250K at Chase Bank, et cetera, right? That's what that means. And you also get that limit for each account type, meaning that you might have a single account in just your name that you would have up to $250K coverage for. And then you can also have, let's say, a joint account with your spouse or your child or something like that. And that account will have an additional $250K. Okay. Now, it's important to note that you have access typically to your money at all times in a checking or a savings account. That means the account is very liquid. So when we say liquid, we're referring to being able to access your money at any time, right? You're going to want to consider a few things when you look at which bank you want to do business with. or credit union you want to do business with. You want to consider perhaps the fees. So some accounts have fees, maybe monthly maintenance costs. Sometimes they waive the fee for some sort of function. Typically, a fee might be like $10 per month, and maybe they waive it if you have some sort of direct deposit from your job or if you have over a certain dollar amount, right? You're also going to want to consider the convenience of the bank or the credit union. You know, where are they located? What are their hours? Do they offer online access? Most of the places do offer online access nowadays, but some of them don't. So you might want to consider that. And you also want to consider maybe if they have a bill pay feature, like can you pay some expenses and have the bank mail a check on your behalf. So it's kind of convenient, kind of cool. You might also want to consider wireability. Some banks let you wire money electronically online. Some of them require that you have to go to the bank to do that. You also might want to consider interest rates, right? What's interest rates? Interest rates is the interest or the kind of the amount of money that they promise to pay you for keeping your money in their bank, right? Why do they promise to pay you money for keeping money in their bank? Because really, technically, and typically, they're making money on your money, right? So you deposit money in a bank, and they're turning around and loaning that oftentimes to someone else and charging a higher interest rate, right? Interest rates are pretty low right now, so typically they're going to be less than 1%. So you want to evaluate that as you take a look at some of these things, right? Let's go through some examples of holding your money in cash. You might have, and again, I'm not affiliated with any of these banks. I don't make money from them. I'm not incentivize them. I just kind of wanted to provide some additional information that might be helpful for the viewers of this course. So you can keep your money at Chase, perhaps Bank of America. Those are big banks that are kind of have a lot of branches in lots of different places. PenFed Credit Union, that's a credit union that is pretty popular nowadays. Capital One is an online bank, so that might be kind of handy. And there's lots of others as well. Another type of investment that you might opt to invest in is a CD, also known as a certificate of deposit. It's an investment normally issued at a bank, and there's usually a minimum investment, like $1,000 or some sort of amount, in order to open a CD. Also, you will have a fixed interest rate. Again, currently the rates are very, very low right now because the interest rates in general are low. You're also going to have a fixed maturity date. For example, a bank might issue, as an example, a 1-year CD in amounts over $1,000 perhaps, and they might pay a 0.1% interest rate. This means that you have to open the CD with at least $1,000, and you have to keep it in there for 1 year. And what the bank will pay you is 0.1% on the amount that you invested. So if you invested $1,000, you make $1 for the year. Let me say that again. Kind of funny. If you invested $1,000, you make $1 for the year. So as I said, the rates are pretty low. Most CDs are FDIC insured, just like money in a checking or savings account, meaning that if the bank went bankrupt, you don't lose any of your money. Money in a CD usually has to stay in that account for the time frame that you committed to initially. So for example, 6-month CD, 1-year CD, 2-year CD, something like that. Sometimes the bank will allow you to take the money out early, but usually they will charge you a penalty to do that. This is kind of a cool website that I saw when I was putting together the slides for this presentation. Bankrate.com. If you go to this hyperlink, they will if you put your zip code in, they're going to show you different rates at different banks in your area. So it's kind of cool. Stock. Now, who here invests or has invested in stock before? Raise your hand. Of course, probably several of you. Stock is equity in a company, right? When you own a stock, you own a small piece of that company. For example, Disney is a publicly traded company that is owned by its shareholders. That means anybody can buy stock in Disney. You can buy 1 share of stock or 100 shares or 200 shares, and you could even buy what we call fractional shares of stock, meaning that you can buy like a half a share or a tenth of a share or some fraction of 1 share. So that's kind of cool. That's getting a little bit more popular as time goes on. There are a few ways that you make money or can make money with stock. So when you own stock, when you buy stock and that stock goes up, typically you make money, right? So for example, let's say if you buy 100 shares of a stock at $100 per share and it goes up to $110 per share, you make $10 per share. Now it's important to note that you don't actually get paid that money, that extra money that you made, that performance, until you actually sell your shares. So that's important to note. That means it's just a paper gain until you sell the shares. A paper gain, it's also known as an unrealized gain. Now, you can also make money if the stock pays a dividend. So lots of stocks nowadays, on the stock market, they pay dividends. And what are dividends? A dividend is kind of like the way a company shares in their profits with their shareholders, right? So sometimes stocks will like to pay their shareholders dividends because it helps to attract new shareholders. And it also helps to attract the shareholders retain the shareholders that they already have. Now, a lot of technology companies typically don't pay dividends because what they're doing is they're reinvesting their profits in their operations. But, lots of other companies do pay dividends. Oftentimes, dividends are paid quarterly, right? And you can either take the money in cash or you can buy more shares with them. So that's kind of something important to know. And it is also important that dividends are not guaranteed, right? So they're not guaranteed by a company. They can change them, they can reduce them, they can also increase them or limit them at any time. Now, some investors don't know this, but you can also sell a stock short and make money if the price of that stock goes down. So that's kind of a cool thing. That's called selling the stock short. So you don't actually have to own the stock. You're selling it, not owning it, and you're profiting if the stock goes down in value. It's kind of like when you buy a stock. It's going to be a paper gain, just so you know, a paper gain or an unrealized gain until you actually liquidate your position. So if you want more information about that, and by the way, I have a lot of other courses where I dive deeper into some of this content. Now, when you put your trade through, like when you buy stock, there are lots of different places that you can do that. You can do that through a financial advisor, but you can also do that on your own, right? You don't need a financial advisor to buy stock. You can also buy stock directly through the company. Like, for example, if you wanted to buy stock, with AT&T, you can go right to AT&T and buy stock through the company. So there's a couple different ways that you do that. Now, stock is a really common investment for people to invest in, and there are lots of different strategies. So again, hit me up if you want to know more about that. Also, you do want to be aware that there are commissions or transaction charges in order to buy and sell stock. So that's kind of like the expense or the fee or the charge that like the stock exchange, New York Stock Exchange, or the exchange wherever the stock is being traded will pass through to the investor. Let's go through a quick example. Let's say you buy 100 shares of AT&T stock. And this is where it was trading today when I put these slides together, $27.87 per share. Let's say AT&T goes up to $50 per share. What that means is you're going to make an unrealized gain of $2,213. So that's going to be the difference between $50 minus the $27.87 that you paid per share times 100 shares. So that's your unrealized gain. Now, you don't actually recognize or realize that until you sell your shares. So keep that in mind. Also, a stock like AT&T pays a dividend. So currently, AT&T is paying 52 cents per share every quarter. And the next payment date they send out will be on August 2nd, right? But in any event, it's every quarter. And so it's 8/2, and then it's probably like 11/2 and 12/1/2, February 2nd, 2022, and so on. So every quarter as you go. That means that you're going to receive $52 for every 100 shares that you own. Now, you do have to own it as of a certain date. I'm not going to get in the weeds or a lot of details on this presentation, because this is really geared toward just helping people understand what types of investments are involved. Now, also, you should know that the dividend that you receive is cash. So it's not unrealized gain, but it's actual cash that you can keep, cash that you can take out, cash that you can spend, or you can also opt to take that amount of money in a stock instead. So that's important. Let's go through a quick example on selling a stock short. What does that mean? Once again, you don't have to own the stock. In fact, you don't own the stock when you sell a stock short. But it's a strategy that people will consider using when they think that the price of a stock is going to go down and they want to profit from that decline in value. So, for example, you can sell short. We call it selling short 100 shares of Tesla, let's say, as an example. And right now, Tesla is about 714, but I just put in an average of 700. So let's say Tesla is $700 a share right now. You can sell short 100 shares. And let's say Tesla drops to $650 per share. That means you're going to make $50 per share, and you're going to have an unrealized gain of $5,000 in your account. 50 times 100 shares, $5,000. Now, again, it's going to be unrealized. That means you can't spend it. It's not spendable. It's not a constructive, income. It's just a paper gain or an unrealized gain until you actually sell your shares, and then you can spend it, right? That's what that means. Now, remember, I know I just said it before, I'm going to say it again. Stocks are unrealized until you liquidate the position. That's how stocks work. Now, options, I'm going to talk about options a little bit later in these slides. Options let you actually constructively receive the money, which is kind of cool. So stay tuned for that, right? Bonds. Let me talk about bonds. Bonds are debt. So stock is equity in a company. Bonds are the opposite. It's going to be debt in a company. You can buy a corporate bond, or you can also buy a municipal bond. Corporate bond is kind of a bond that's issued by a corporation. Let's say, Disney or Google or, ABC or XYZ. It's a corporation. And let's say they want to raise capital for whatever project, and they're promising to pay investors a certain fixed rate of interest. Now, the other type of bond is a municipal bond. So municipal bonds are issued by municipalities or governments. So you can buy a municipal, like I am in Los Angeles. You could buy a Los Angeles bond. You could buy a state of California bond. You can buy, New York City, Puerto Rico, whatever. So municipal bonds, the advantage of that is basically typically that they're going to be tax free. So the interest or the income that you get from the bond is going to be tax free. So if it's a state bond, you don't have to pay any state tax. If it's a city bond, oftentimes you won't have to pay city or state tax. So like, for example, if you live in New York will have, you have federal tax, you have state tax, and you have city tax often. So you're triple taxed in New York, as an example. Federal tax, state tax, city tax. So oftentimes, let's say if you have a New York City bond, you get what we call triple tax exempt. You don't have to pay federal income tax on the income that you receive. You don't have to pay state income tax, and you don't have to pay city tax. If you have a corporate bond, that is going to be taxable. So it's going to be taxable. So you have to pay Uncle Sam, right? Bonds will also have a credit rating. So the credit ratings, there's a few different credit bureaus. There's S&P, there's Moody's, there's Fitch. And what they do is they give the bond a rating like A rating, B rating, and that suggests to investors how much or how little risk that particular bond has. Now, it's important to keep in mind, you want to do your own due diligence. So those of you who were back in the 2007 and in like the economic meltdown, right, when the market went down significantly, the credit crisis of 2007, 2008, lots of those bonds were A-rated and ended up going bankrupt. So it's important, just because a bond is A-rated doesn't mean it's guaranteed, right? So it's just an estimate. So keep that in mind. Bonds, once again, will pay a fixed interest rate, and they will also have a fixed maturity. So they're going to, let's say, pay 1%, 2%, 5%. They're going to have a maturity date of, let's say, 1 year, 5 years, 10 years. When the bond matures, when that fixed period is up, you get your money back, your initial investment. We call that par value. And it's also important to know that your bond is liquid, meaning that you can sell it if you needed to, if you wanted to, at whatever the market is dictating. So let me go over some of that in more detail here, right? Let's say, for example, the city of Los Angeles is raising capital to fix the roadways. They are issuing a bond, a 10-year bond, and they're going to promise to pay investors 2% semi-annually or twice a year, right? So let's say, for example, you invest $10,000, you're paid $100 2 times per year. It says 2 per year. I'm going to have to, it's a typo on that slide there, 2 times per year. And the way you get that amount is because you're investing $10,000. So 10,000 times 2% divided by 2, because you're paid that twice per year. When the 10 years are up, you get your $10,000 back, right? That's the way that works. If you wanted to sell your bond before the 10 years are up, you can do that anytime based on market rates. Now let's talk about that for a moment. Bonds and interest rates work inversely. What that means is if interest rates go up, bond prices go down. And the opposite, if interest rates go down, bond prices go up. And that kind of makes sense. So let me give you an example and let me show you why that's logical. Let's say you have a 5% bond that comes due or matures in 10 years, right? It's 5%. Now, right now, the interest rates in the environment and the economy are super low, right? So if the interest rates go up, the value of your bond is going to go down. And the reason for that is because who is going to buy your bond at, let's say, $10,000 and get 5%, like moving forward, if they can go somewhere else and get 6 or 7 or 8. So that means your bond has to be discounted to make up for the difference in interest rates. So that might sound confusing. I'm going to say it again. Sometimes people, kind of get lost a little bit in this. Rates go up, bond prices go down. Rates go down, bond prices go up. And that makes sense because who is going to, let's say interest rates, go down, then your bond is going to be worth more because other investors can't find the same type of investment for the same rate. They're going to get a lower rate. So your bond is worth more money. That's the reasoning behind that. Okay. The next investment that sometimes people will invest in. Lots of people have heard of mutual funds before, right? Mutual fund is a pooling of stocks and or bonds. You could have both. You could have one or the other in there. There's typically a low minimum investment. Different mutual funds will have different minimum investments, but some might have, $50, $100, $1,000, that kind of thing. They trade at the end of the day. What that means is if you are buying a mutual fund or X dollars in a mutual fund, you're buying $500 in mutual fund ABC. It's not going to trade intraday or throughout the day. There's one price that you're given at the close of that day. Now that can be very. I want to stop for a moment and let people know what that means. What that means is if the market's dropping significantly, let's say we have some sort of a crisis and the stock market is dropping substantially, you don't have the ability to get out midday. You take whatever price that fund has at the end of that day. So that's a downfall. That's kind of like a negative to mutual funds. So keep that in mind. Mutual funds are very liquid, meaning that you have access to your mutual fund. You have access to the money in that anytime. So let's say if you invest in a mutual fund, let's say $100, and you wanted to sell that fund for whatever reason, you could sell that right now, today, tomorrow, the next day. And typically you have your money 3 days later. There are certain timeframes. Typically it's a settlement is going to be 3 days later. You could buy a mutual fund in one of 2 different ways. You can do a load fund or a no load fund. Load just means commission. So you can pay a commission or you can not pay a commission, right? If you are buying a commission mutual fund, there are 3 different ways that you can do that. You can do an A share, a B share, or a C share, right? And that just kind of refers to when you're paying the commission. So A share, you pay the commission up front. B share, you pay the commission at the back end, and C share is kind of level where you're paying a commission, all throughout time, as long as you own that fund. right? So C shares are typically over the long term going to be the most expensive over the long term. No load is no commission. And I'm going to show you some examples on a couple of slides from now. But as far as where you can buy that, you can buy that through a broker dealer or through a mutual fund company. So most people that invest in mutual funds, they do so via their 401k at work, right? We're going to talk tomorrow about different accounts types, 401k, 403b, but most of the people that invest in mutual funds are doing so via their employer-sponsored retirement plan. I do want to make everybody aware, and you might already know this, that most mutual funds don't outperform their benchmark. What that means is, let's say if you have like a mutual fund that's kind of trying to get the performance of, like, let's say the S&P 500, there are fees associated with that fund because, they're actively managing that fund. And oftentimes they don't even do better than the S&P. So what ultimately ends up happening is investors pay fees for an investment to try to get better than the performance somewhere else. And you end up paying a fee and not getting a better performance than elsewhere. So that's something that you might want to keep in mind. It's estimated that 97% on average do not outperform their benchmark. And again, this is why usually, in my view, most of the people that invest in mutual funds are only doing so because they don't have availability to like other investment types, like through their retirement, employer-sponsored retirement plan. Let's go through some examples of mutual funds. Some load mutual funds, American Funds, Growth Fund of America, that's one specific. And again, I'm not recommending these. I'm not like incentivized by any of these. I'm just giving you examples to help you understand better. So please keep that in mind. Another load fund is Franklin Templeton. Some no load funds are Fidelity and Vanguard. Now, an ETF, or an exchange traded fund, is kind of like a mutual fund, right? Except it trades like a stock. So an ETF will trade what we call intraday. So you can buy it now. You can sell it 5 minutes from now. You can buy or sell an ETF anytime the market is open, which is going to be between 9:30 and 4 o'clock Eastern Standard Time, Monday through Friday. So they're not traded end of day like a mutual fund, but they're traded intraday. So it's a little bit better. And usually their expenses are also a little bit lower than mutual funds. They're also like pooling of investments like stocks and or bonds. And you can also buy fractional shares, which is kind of cool. So like fractional shares are kind of, a newer thing. Like you don't have to buy one share. You can buy, half a share, that sort of thing. And you can also, interestingly, sell short an exchange traded fund. So like, for example, I talked a moment ago about selling a stock short or something like that. You can also do that with an ETF, right? So that's kind of cool. Here's some examples. And again, I'm not recommending any of these, but just some examples. SPY is like, pegged or tied to the S&P 500. QQQ is a technology exchange traded fund. So it's got stuff like Google and Facebook and that kind of thing in there. VNQ is a real estate ETF, exchange traded fund, right? One of the biggest differences between mutual funds and ETFs is when it trades. So like I said, does it trade end of day or does it trade intraday? That's important, particularly if you wanted to get out if the market is having a significant correction. Generally only use, I mentioned this a moment ago, only use mutual funds and accounts where ETFs are not available. Now, again, I'm not giving you investment advice. I'm just giving you some information. I've been in this space for a very long time. 1997 is when I started. We're in 2021 right now. Wait, how many years is that? I need a calculator for that, which goes to my point. People think like you have to be good at math, in order to be good at investments. No, you don't. So I use a calculator a lot. 24 years I've been investing. And over the years, I've learned a lot. I've done a lot of different things in a lot of different, platforms. And so I want to help provide the information so you can, make smarter investment decisions moving forward. So real estate is another way that we can invest our money. You can buy physical real estate, or you can also invest in a real estate investment trust, or a REIT, REIT, real estate investment trust, right? Now, a real estate investment trust can be private or public. We're going to talk about that in a moment. Let's go through some of these examples. Physical real estate. Physical real estate is kind of like a short-term rental, long-term rental, right? Airbnb and VRBO. Those are short-term rental platforms. So those can be very, very lucrative. I myself have some property. I live in Los Angeles, and I have some property that is in the Virgin Islands. And it's kind of cool because I rent short-term through Airbnb and VRBO, and it's very lucrative because a lot of people are going on vacation. You can also rent long-term. You can buy some property. It's funny, I live in LA, like I said, and I was looking at, let's say, some property, buy an apartment or something like that in Los Angeles and rent it long-term. It's harder to make money like that because the prices are so super high right now. But those are ways that you can make money. You can also make money via a REIT. So again, like I mentioned a moment ago, they can either be publicly traded or privately held, right? So one of the biggest differences between publicly traded and privately held is liquidity. A publicly traded REIT like O or VNQ, you buy it like a stock or an ETF. You can buy it now, you can sell it in a minute, that kind of thing. And it's very liquid. So you have access to buy or trade it, on the fly. Privately held REITs are not liquid. So typically private held REITs, you're locked into that particular investment for a period of time. So that's something that you definitely want to keep in mind. Me, myself, everybody's got their own thoughts and objectives. However, I truly believe that most people should look at investing in liquid investments because you don't know what tomorrow is going to bring. If something comes up and you needed access to your capital, you are better having invested in a liquid investment. So you have access to it and you can access the cash or the funds from that investment at any point. So keep that in mind. Insurance, there's different kinds of insurance. You can have life insurance, you can have annuities, right? They're both kind of insurance. And in those, there's also subsets. So life insurance, you can have term insurance or permanent insurance. It depends on what your objective is. So me personally, I have term insurance, right? So I want to buy a lot of insurance, the most possible. And I only have, in my view, a need for insurance for a shorter period of time. So I have a temporary need for insurance. Why? Because I have younger kids, right? So my youngest is 16. So I don't need insurance 50 years from now. 50 years from now, my kids are going to be on their own. And it's my hope and my assumption that they will be successful. So they don't need my money 50 years from now, right? So usually, people will want to buy oftentimes a bigger amount for a shorter period of time to fill that need. So that's term insurance. Term is temporary. There's no cash value to a term policy. So let's say you can have a 10-year term policy and you pay X dollars per year and you have like a certain death benefit, let's say $1 million, $5 million, $10 million, that kind of thing. That's the way term insurance works. It's cheaper, less expensive than permanent insurance. Permanent insurance, you can purchase universal or variable universal. It's typically tied to some sort of interest rate or the stock market. And you do build a cash value as you go. It is important. I want you to pay attention to some of the things that I talk about in this presentation. It's important if you have permanent insurance to review your policy on a regular basis. Why? Because you might think that you are paying, let's say, $500 per year and you have $1 million coverage and it's forever until you die. And that's not necessarily the case. Oftentimes, insurance is one of those things that can be very confusing to customers. It's sold and not always understood 100%. And oftentimes people think that they have coverage and over the years, things change and perhaps your expenses are going up and the market or the interest rates, have gone down. Your policy might do to what we call implode. It's not necessarily guaranteed through the rest of your life. So it's important to review your policy. Annuities. There's a couple different kinds of annuities. You can have a fixed annuity or a variable annuity. There are some additional pieces of information about annuities that you want to be aware of. You want to understand the income guarantee. So oftentimes an annuity will have a guaranteed income. So it will be, let's say, it's going to be guaranteed to pay you, 5% off of some bucket of money for the rest of your life or something like that. But you want to understand how they work. Annuities have a lot of different moving pieces to them, and oftentimes they are also, like life insurance, a little bit misunderstood by investors. You want to also understand the built-in expenses. Annuities can be super, super expensive. People don't see that sometimes. So you want to understand that. Sometimes I've seen annuities have upwards of 5% expense built into the contract. 5% is a big number, right? So on average, the stock market makes like 8% per year over the long term. That's like, an average estimated amount. Now, if you're paying a 5% fee and you're making 8%, it's dragging on the performance. So it's important that you understand that. You also want to understand the lockup period. So oftentimes annuities will have a lockup period where you can't access your money for a period of time. You also want to understand the commissions. I want to tell you a little bit, a brief story. I used to be registered through LPL Financial a while back, and many of my colleagues would run around selling annuities to investors. And the reason they did that, perhaps they thought that it was a good investment. Oftentimes, investment advisors are incentivized by the commissions that they can make. And I can tell you that many annuities are paid a 7 or an 8% commission to the investment advisor, right? The financial advisor. So let's say you retire and you roll over your 401k into an IRA, and your financial advisor down the street recommends an annuity. You just want to be aware that they might be recommending it because they're going to make a $7,000 or $8,000 payday on your account. So you just want to be aware of things like that. I have other programs, other classes that talk more in depth. So again, this program here, this Investment 101, is designed to give you sort of like a preview on all the different investments and the different account types that you can have. But if you want more information about any of these specifics, hit me up and I can direct you to some other programs. You need to perform due diligence before buying an annuity. That's super important. Keep that in mind. Also, I do want to let people know that you have the ability to use life insurance to get tax deferred or even tax-free objectives, to fulfill tax deferred or tax-free objectives. So that's kind of cool. Again, hit me up if you want more information. Another investment that we can invest in is a hedge fund private placement. I personally had run a couple of different hedge funds until very recently. Hedge funds and private placements have a couple of things in common, and then they differ by a couple of things. One of the things in common that they both have is they're not liquid, meaning that you don't have access to your money all the time. So there's a lockup period. It could be locked up for a period of time, meaning that if you need to access your money, you might not have the ability to do that. Also, hedge funds private placements are geared toward accredited investors. What are accredited investors? Typically, investors that have a net worth of a certain dollar value. So typically, more seasoned investors, maybe $2 million, or they have a certain annual income. Accredited investors. Now, hedge funds typically will invest in publicly traded companies, like have stocks or options in them, where private placements will typically invest in privately held companies, like they might own real estate or something like that. Hedge funds are usually open-ended, meaning that, people can come and go, invest and not invest and pull out of a hedge fund. And private placements usually closed-ended. So they issue sort of a private placement initially, and everybody kind of jumps in at the same time, and everybody kind of jumps out at the same time. So that's what that means. Now, you do want to read the fine print, and you want to perform proper due diligence when investing in a hedge fund or private placement. It's my experience that many people that have invested in hedge funds and private placements don't necessarily understand a lot of the ins and outs of those investments. You want to make sure you take a look at that. Cryptocurrency. Ooh, yeah. That's like one of my favorite things lately, cryptocurrency. Blockchain, right? Who's familiar with cryptocurrency, blockchain? Raise your hand. That's stuff like Bitcoin, Ethereum, Litecoin, Ripple, tons more. There's lots of different cryptocurrencies. They're held on exchanges, right? They're held on exchanges, or you can buy cryptocurrency through an ATM machine. An ATM machine, it's kind of like an ATM machine, but you put like fiat currency, you put like let's say US currency in, and then you get some sort of cryptocurrency like Bitcoin out, so to speak. You can hold your assets in a couple different ways. Cryptocurrency, you can either have web-based, you can hold your Bitcoin via a hot wallet, which is web-based, or you can hold your Bitcoin via cold storage, which is hardware-based. It's kind of like let's say a Trezor wallet or something like that. Trezor wallet, as an example. Now, you definitely want to be aware of fees. Fees are crazy. Like cryptocurrency is like kind of like the wild, wild west. There's not a lot of regulation right now because it's kind of new. And you might not be aware that, the fees can be greatly, different from one platform to another. So you want to do your due diligence. You can also invest in crypto via stock, which is kind of cool. So you can, these are, again, I'm not recommending anything. I'm just kind of giving you some info. Riot, Mara, Coinbase. Coinbase recently went public. That's fairly new. So you can invest in the crypto hype, so to speak, via stocks. So the advantage of doing that is that it's going to be a little bit more regulated, right? So the stock market is definitely regulated, whereas cryptocurrency is not as regulated, and it can be easier to invest, let's say, in cryptocurrency. And really the way it works is, let's say Bitcoin goes up, typically, the tide rises, all boats rise. That's kind of like, so to speak. So Bitcoin goes up, Coinbase typically goes up, and vice versa. Bitcoin goes down, Coinbase typically goes down. So it's a way that you can kind of, get on the crypto hype without, investing in actual crypto, but you do it via stock. Alternatives. Oh my gosh. Alternatives are my favorite. This is kind of like toward the end of the presentation, and it's my absolute favorite because I am so passionate about options, right? And I know this comes through when I talk about it. Alternative investments are like options. Options are going to be derivatives. Now, I don't want to confuse you with these lingo terms or anything like that. Just know that an option is the right, not the obligation, but the right to buy or sell something at a certain price before a certain date, right? So an option has what's called the underlying, like what you're trading the option on, whether it be like Apple or Tesla or something like that, at a price, $500, $100, et cetera, before an expiration date, this Friday, next Friday, 2 Fridays from now, that kind of thing. Now, I have tons and tons of courses and material that talk about options. So if you start catching my drift, what I'm going to put down with options, hit me up and I'll give you some more info on options. Okay. You can trade options on different things. You could trade options on most stocks like Tesla, Coinbase, Google, Amazon, AT&T, that kind of thing. They can be aggressive. They can be conservative. You can also trade options on ETFs. You can trade options on like the S&P 500 index or SPY. That's an ETF. SPY has some cool options because they have like 3 expirations every week. So you have like Monday, Wednesday, Friday. So when you have like a lot of different expiration dates, you can lock in your profit on an ongoing basis. So here's the big thing between the stocks and options. Stocks, you buy Tesla stock and you buy it at 700 and it goes to 1,000, right? Okay, that's great. And you look at your statement and you made a lot of money and whoo-hoo, that's awesome, right? But can you spend it? No, it's unrealized gain until you actually sell your stock, right? I don't know about you, but my view is that most people do or should invest money for spendable money, right? I don't invest money because I want to see some on my statement or online. It's a green number because my price went up or my value went up. I want to invest money because I want cash in my pocket and I want to go spend that. I want to go buy an airline ticket to Greece, or I want to take my kids to a restaurant or to the movies or something like that. That's why people do or should if you're not already investing. So that's what options do for you. I'm going to get to that in a moment. But going back to my slide here, I'm getting ahead of myself because I'm so excited. You can trade options on stock, ETFs, commodities. That's how I got my start way back in 1997. I started with commodity options, gold, silver, currencies, pork bellies, soybeans, that kind of thing, right? Bitcoin. You can trade options on Bitcoin, which is kind of cool. I have a whole program on that. If anybody's interested. There's different ways that you trade options. So check it. This is kind of a cool slide. You can buy an option or you can sell an option, right? So again, you don't have to like understand the nitty gritty of these things. Just try to understand conceptually. If you're buying an option, you're usually doing that for one of two reasons. You're either going to hedge your portfolio. So let's say, for example, you have a bunch of stock and you're afraid if the stock market goes down, you're going to lose a bunch of money, right? You might buy options to protect you against losing a bunch of money, right? So it's a hedging strategy. It's like buying insurance on your investments. Number two, you might buy an option because I have gambling there, but you might want to 10x your investment, right? So buying an option gives you the ability of, let's say, if you think that a stock, let's say, is going to go up or down significantly, like you think that's going to happen in a certain period of time, you might, instead of trading that stock instead of buying that stock or something, you might buy a call option on that stock. And the advantage of doing that is you, let's say you limit your investment to, let's say, $100. You could put up $100 instead of more money. You could put up only a small amount of money, let's say 100 as an example, and you could turn that 100 into 1,000 or 10,000 if you're correct on the direction and the timing of that particular stock. So it's a way that you can 10x your money. You get like, you put up 100 and you make 1,000. However, it's kind of like gambling. It's kind of like, in my view, it's analogous to slot machine. You go into the casino, Caesar's Palace, you put $100 in the slot machine, you pull the lever and maybe you hit a jackpot, right? But what's the likelihood of doing that? The likelihood of hitting a jackpot is like 1 in, 100 or whatever. So the likelihood is more so that you're going to put your 100 in and lose your 100, right? Me, I don't buy options. I sell options. When you sell options, you have the ability to create systematic income for yourself, right? So I spoke a moment ago on creating income and having realized or unrealized gains, right? So I'm going to say it again. Let's say you buy Tesla stock and you buy it at 700, goes to 1,000, you made $300 a share. Amazing, amazing. But you can't actually spend any of that money. When you sell an option, you get paid right away and you can spend it right away if you wanted to. So it gives you the ability to create systematic, steady streams of income for yourself. Here, I want to give you guys actionable things because I want to make sure that this information is great for people that are new. And I want to make sure that this information is great for people that have, you think you've been around the block. So I want to give you two really cool ideas, right? You could sell a put, sell a covered call. I know that sounds confusing, but I'm gonna break it up and I'm gonna tell you I want you to understand conceptually. Let's say Tesla. Tesla is like one of my favorite stocks. I'm going to use them as an example. You can sell a Tesla put. Now, Tesla right now is $7.13 a share. That's where it was today and some change. You can sell a put that expires this Friday, August 13th. What's today? Today's date is August 9th. So this there's an option that expires this Friday, 4 days from now. Let's say you want to sell a 650 option. That means that if Tesla drops to 650, right now it's 713, right? If it drops to 650, you're going to buy 100 shares. So you get to choose at which price you want to buy the stock if it drops to that price, right? You can say, oh, I like Tesla. Tesla is $713 per share, but I don't want to buy Tesla at retail price. I want to buy it at a discount, right? I only want to buy Tesla if it drops to 650. You can do what's called selling a put. You sell a 650 put. It expires this Friday. Now, there's only a 5% mathematical likelihood that Tesla is going to go from 713 to 650 between now and the next 2 days. So it's not very likely. However, if it does, you're going to be able to buy 100 shares at 650. And even if it doesn't, you are going to collect a premium. So for the commitment to buy it, if it drops to a certain price, you are going to get paid $94. Now, that doesn't sound like a lot of money, right? but you're going to get paid $94. This is a way that you can create yourself systematic, steady streams of income. $94 gets dropped into your brokerage account today, right now. You can spend that if you want. You can go out, take your kids out to dinner and go to dinner with your spouse, right? Whatever. You could buy a new phone case at the store, whatever. If Tesla is 650 or lower between now and Friday, you're going to buy 100 shares at 650. Well, that's pretty cool. That means you're going to buy it at a discount because it's 713 right now. If it's not 650 or lower, guess what? You're not going to buy any Tesla. Either way, either of those scenarios, you're going to keep the $94 regardless. That's kind of cool. So you're making yourself money. That's idea number one. I know we're running short on time, and I know I'm kind of talking a little fast. And if you want to know more, hit me up. I'm happy to share. Idea number two, you could sell a covered call. Now, let's say you already own 100 shares of Tesla. Selling covered call is kind of like making money in different places, right? So it's kind of like having a cow on a farm and selling the meat for beef, and then also selling the milk, right? Making money in two ways. That's what a selling call is. Let's say you already own 100 shares of Tesla. You can sell now. Again, Tesla's 713. Let's say you want to. You're cool with selling your shares if it goes up to 750, right? So it's 713 now. You're cool with selling it at 750. You can commit that you're going to sell you can commit today to somebody else that you're going to sell your shares at 750 if it hits that price between now and Friday. For that commitment, you get paid $170. Now that's what I'm talking about, right? $170 gets dropped into your brokerage account. You get to spend it. Now there's only a 10% likelihood that Tesla is going to go from 713, where it is now, to 750 in just a handful of days, 4 days, right? 10% likelihood. But if it does, you're going to sell your shares at 750. If it doesn't, you don't sell your shares. Either way, you keep the $170 that was paid to you. I'm going to say that again. Either way, you keep the $170. Now, when you sell a covered call, I want everybody to pay attention to what I'm going to say next, this next sentence. When you sell a covered call, you cannot lose money. It is not possible for you to lose money. I'm going to say that once more because I know sometimes people can't believe their ears when they hear that. When you sell a covered call, it's impossible for you to lose money. Let me explain to you what I mean by that. You already have the shares. So the shares might go down and you might have a short-term like unrealized loss, but you already had that risk before you sold the option, right? That's not a new risk. You already had that. The only thing that you can lose by selling covered call is, let's say the price skyrockets to $900. Let's say now Tesla is 713 now, and you sell a 750 call, and oh my gosh, something happens and that stock goes to 900 like Friday, right? You're going to sell your shares at 750. So you might give up some of the gain, but you're not losing any constructive money. You do not lose money. You make that $170 no matter what. So you're locking in a profit no matter what happens to the stock. And it's letting you, let's say if you own a farm in Idaho and you're raising some cattle to sell to the meat market. This is a way of also making money on milking that cow at the same time. So you're making money in two different ways. It's kind of cool. I know I'm talking fast. Again, I have more information. That's kind of like an advanced options are like an advanced topic, but I'm talking this course, Investing 101, is about different ways that you can invest your money. Now, the advantages of options over stock, I want you to pay attention to the bullet point. You can create constructive realized income on a regular basis. So options, many options have expirations every week. That means you're creating yourself weekly income. Some options like SPY, like I mentioned before, have 3 times a week expirations, Monday, Wednesday, Friday. So you can lock in your gains every Monday, every Wednesday, every Friday. So you're not subjecting yourself to the volatility or the gyrations of the future stock market performance. So that's important. Number 2, you don't even have to buy any stock. Oh my gosh. You can make money and not own any stock. You could just sell puts and make income. Number 3, you could start with a smaller dollar amount. Like you don't have to buy, 100 shares of Tesla at $700, $70,000. You could start with like $500. You could start with $200. I mean, obviously most people start with a little bit more. Maybe 2,000, 5,000, 10,000, but you could legit start with $500. I have a course that I'm doing right now where you could start an account with $500 and create yourself income on an ongoing regular basis. Number 4, you lock in your gains in short periods of time. Now, I want to say this in a different way, and I said a moment ago, but I want to just explain to you. you lock in your gains so you're not subjecting yourself to future volatility. We don't know what the market's going to do tomorrow. We don't know what it's going to do tomorrow, next month, next year. So why would you subject yourself to volatility? Dude, if you trade stock, you should be trading options. That's my view, and I'm sticking to it. Today, we're going to talk about the different types of accounts that you can have, right? So there's two real groups of account types. You have taxable accounts, and then you also have tax deferred accounts, or sometimes they're also called retirement accounts, retirement plans. So we're going to talk about specific ones and how they work and the functionality of each of them, to help you make better investment decisions moving forward. So we're going to start with the taxable accounts first. This is a listing of taxable accounts. You can have a single account. What is a single account? It's owned by one person, right? It's in your name. You can avoid a probate, and I do have a separate slide in a moment that talks about a transfer on death. I'm going to skip that for now. You can also have a joint account. So a joint account is owned by at least two people, and that could be a joint account that the owners have an equal right to the assets, or in a joint tenants in common, a JTIC account, owners have no rights of survivorship. So either, let's say, for example, you have an account that's owned by, two people. When one person passes away, the difference would be whether the assets belonging to that individual move over to the other individual on the account, or if they don't. So that's the difference between what we call JROS or JTIC. You can also have a trust account. Now, there are a couple of different types of trust accounts. The most popular that I often see will be a living revocable trust account. It's an account that avoids probate, right? So if you've ever, raise your hand if you've ever experienced a death in the family in which it was someone that was close to you. And if you ever experienced the probate process. So probate will happen typically for people sometimes that pass away that don't have a will, but also if you do not have your investments titled a certain way, your assets may go through what's called the probate system. So probate is a court system that's designed to for the court to really understand and figure out, where should these assets go? And there's a cost to that as well. There are probate fees and probate taxes applicable. But when you have a living revocable trust, the advantage, one of the biggest advantages of an account type such as that, is that your assets will pass automatically to the beneficiaries, avoiding probate completely. So it's very advantageous. And also, in addition to that, it also protects the privacy of the account holder and the beneficiaries. So it's not public knowledge like probate, the probate process is. There also can be some tax advantages. I do want to let you know, obviously, I'm not an attorney and I'm not a CPA. An accountant. So you do want to consult perhaps an attorney or an accountant for more details. This presentation, as I mentioned yesterday, is a presentation designed to help you understand the basics of investment types, investment accounts, and that sort of thing. There are also another type of trust that you might want to establish would be an irrevocable trust. So like the name suggests, an irrevocable trust is not revocable or not changeable. So once you establish that, you can't make changes to it. Irrevocable trusts are very popular with life insurance. They are called ILITs, irrevocable life insurance trust. And there are certain tax benefits associated with that you might want to look into. A moment ago, I talked about beneficiaries, and this is important that a lot of people can sometimes overlook when they are establishing, an investment account. And also, this is applicable for bank accounts as well. So you may want to look into adding what we call a TOD. Oftentimes, there's no expense, no extra charge to adding a TOD. It's also called a transfer on death. And what that does is that will have the account avoid probate as well. Let me give you an example. Let's say you have an individual investment account held through whoever, Charles Schwab, as an example. If you had, just a regular account with no TOD and it's titled to your name individually, if you were to pass away, that account would go through the probate process. Now, probate has three things that are very applicable that you'd want to be aware of. Number one, there's a time cost to probate. So probate is a very lengthy process. It's not overnight; it takes a while. And when that's being probated, that account or the accounts after an individual passes away, the beneficiaries don't have any access to any of the funds inside of those accounts. So that's an important thing to note. So sometimes, it can be helpful for a beneficiary to be able to access some of the funds to pay for final expenses or something like that. So number one, probate is a lengthy process. Number two, it's a costly process, right? So there's going to be probate fees and probate taxes. And then also number three, relative to probate, it's all public information. So in order to avoid that, you can do that via a living revocable trust, or you can add a simple TOD, transfer on death, onto your account. So keep that in mind. Not every company offers TODs, so you'll want to check with the company that you are doing business with. Let's switch over to retirement accounts in your own name. So there are two basic self-retirement accounts. The first would be a traditional IRA, and the second would be a Roth IRA. Now, both of them are individual retirement accounts. That's what IRA stands for. And there are a couple of key differences between the two. The most important difference, before I head on to the next slide, between a traditional IRA and a Roth IRA is that they're both tax deferred. However, a traditional IRA, you will typically get a tax benefit for contributing money today, right? So you get a tax benefit on today's dollars contributed, and you take out the growth in the future, and you pay tax on that. So you get the tax benefit today, and then you pay tax tomorrow, right? A Roth is the opposite. So a Roth IRA, the contribution dollars go in post-tax, so you don't get any tax benefit on contributing the money. However, you get all of that growth subsequently completely tax-free, which is kind of cool. So let's go over specific differences and details on each as well. So traditional IRA, once again, you're going to get a tax deduction now. So let's say you contribute $1,000 to a traditional IRA. If your income limit is under a certain amount, you get to take that $1,000 off as a deduction. You get to use that as a deduction on your taxes. Now you are limited to how much you can put in to a traditional IRA. So, and these limits, by the way, and all these numbers, by the way, change from year to year. So it's important that you want to look that up. But right now we're in 2021, so I'm giving you 2021 numbers. So currently the contribution limit is $6,000 into a traditional IRA. So you can put in 1,000, you can put in 2,000, you can't put in any more than 6,000. You do get what's called a catch-up provision. So if you're over 50 years old, you get to put in 7,000 instead of 6,000. So that's kind of handy. Traditional IRAs also have what's called required minimum distributions. You might have heard that before. They're also called RMDs. So once an account holder hits age 72, now it used to be 70 and a half. Again, these numbers change from time to time. Typically, many of these categories will change every year, and some of them change every so often. So required minimum distributions used to have a lower age requirement. Now they are after age 72, where you have to start taking your money out of a out of a traditional IRA. The reason for that, anybody know the reason for that? Hit me up in the chat box or raise your hand. The reason for that is that the government does not allow people to grow their money, tax deferred forever. So really they want their taxes, right? So that's really what it all boils down to. So once you hit age 72, you have to start taking a distribution. Now, if you don't take a distribution, there's a penalty. So you want to make sure that you pay attention to that. And the amount of money that you have to take is a mathematical equation, and it changes from year to year. So that's something that you'll want to look up when that you become that age and that's applicable. Modified adjusted gross income limits for deductibility. A moment ago, I mentioned how when you contribute dollars into a traditional IRA, it's typically going to be tax deductible. Now, when I say typically tax deductible, it is based on your income. And again, these limits change every year, but currently for 2021, for example, if you are single, if you make under $65,000 per year, you can deduct all of your contribution dollars into a traditional IRA up to your $6,000 limit, or $7,000 if you're over 50. If you're married filing jointly, there's a different limitation, and married filing separately is a different limitation as well. So keep that in mind. Now, traditional IRA, the cool thing about traditional IRA is if you wait until you're 59 and a half years old, you can take out what's called qualified distributions. That means you can take out as much money or as little money as you want after 59 and a half years old. And you won't be subject to a penalty or anything. Remember, these accounts are for retirements. So if you take a withdrawal out of an IRA, traditional IRA account, prior to 59 and a half, you will pay a 10% penalty as well as the tax. So something important to understand. Now, non-qualified distributions, as I said, are subject to a 10% penalty. However, there are some exceptions to that penalty rule. So, for example, death or disability of an account holder avoids the 10% penalty. If you are subject to a qualified domestic relations order, that typically comes from the result of a divorce. When two people get divorced, oftentimes funds are distributed out of a traditional IRA, and in that case, there's no 10% penalty applicable. If you are taking out a withdrawal subject to higher education expenses, college expenses, you can avoid the penalty. First-time home buyers, IRS levy, if the IRS levies your account. If you have medical expenses over a certain percentage of your adjusted gross income, you can avoid the penalty. If you're active duty military, and last but not least, 72T distributions. If you take out a series of substantially equal distributions out of a retirement account, out of an IRA, you can avoid the 10% penalty if you take those distributions for the greater of 5 years or until you hit age 59 and a half, right? Now, nobody fall asleep on me. I know sometimes this information can be a little bit kind of boring. I'm trying to make it, perhaps as interesting as possible. It's going to be a lot of information. But again, this is important for you guys to understand because, why do we want to understand retirement accounts? I'll tell you why. Here's the biggest reason. Number one, everybody's going to get to some spot in their life probably in which perhaps they might not be working anymore, right? And where are you going to fund your expenses, your cost of living, your lifestyle? Social Security was never meant to be a sole source of income for people, number one. Number two, even if you do have Social Security, and I say even if you do is because the Social Security system is set to be bankrupt unless there are substantial adjustments made. But again, it was never meant to be a sole source of income. And then also, in addition to that, 50 years ago, there used to be pensions, right? So pensions were popular. A lot of people working for companies, for 50 years, and then they received a pension at the end. That's becoming less and less popular nowadays. So it's important to save for retirement. And how do you save for retirement unless you understand the different options that are available to you? So I know some of this stuff can be a little bit boring. I'll try to make it as interesting as possible, but it is important for you to know. Roth IRAs. So Roth IRAs are really cool. So why are Roth IRAs cool? Here's the biggest thing. Roth IRA is the first bullet point. There's no current tax deduction, but it grows completely tax-free and it gets withdrawn tax-free. So why is that cool? Number one, there's two things that make a Roth, way more cool. So number one is kind of like when you start. So let's say you start a Roth when you're young, right? That means you have all those years to go, saving and growing the money in that account. And then you get all that completely tax-free, which is kind of cool. And then number two, where do we what do we think of the tax climate in today's society, right? So I know oftentimes we all think that, like, oh my gosh, we pay too much in taxes, but really the truth is, if we look at the taxes historically, our current tax rates are not that high. They're probably going to go up. I don't know, I can't tell the future, but I can have sort of an estimated anticipation. I think taxes are probably going to go up as time goes on. I mean, the government is printing more money. Where is that going to come from? We're in trillions of dollars in debt. It's got to come from somewhere. So typically it comes from taxes. So if you believe that taxes will be going up in the future, and if you have a lot of time to go, the younger you are, the more advantageous it is. A Roth can be very beneficial. So that's kind of cool. Also, there are no required minimum distributions applicable in a Roth. So the government doesn't tell you that you have to take your money out. And the reason for that is because when you take your money out, you're taking it out tax-free. So they don't care. They're not collecting tax. So you can keep it in there as long as you want. Another cool thing about Roth IRAs is that you have access to your contribution dollars at any time. So that means that, let's say I'm putting money in a Roth, and then an emergency pops up and I need to withdraw some of my money. And let's say I'm 40 years old or something, and I'm not yet retirement age of 59 and a half. I can withdraw my contribution dollars without a penalty. So it's a little bit different than a traditional IRA. Now, not everybody can contribute to a Roth IRA. There are certain modified adjusted gross income limitations. So if you make too much money, you can't put money into a Roth, right? So here's the amounts. Again, they're going to change every year. Now you can convert traditional IRA money to Roth IRA. It's a little bit more involved. And again, this presentation is really like, sort of basic information, but if you want more information, please let me know. But know that is a strategy that people do take advantage of, is converting traditional IRA money to Roth IRA. And you can kind of get around the income limitation by doing that. You're going to pay tax now on whatever the amount is, but you are going to get that future tax-free growth, which is kind of cool. I mentioned already traditional versus Roth. I mean, do you want to pay taxes today or do you want to pay taxes tomorrow? That's something that you want to consider. You want to consider where you think tax rates will go. How much time do you have until retirement? The longer you have, the more time you have for all that growth, the more advantageous it could be, because then you get it completely tax-free. Now let's kind of adjust gears slightly. Let's talk about retirement accounts, work retirement accounts. At the bottom of this slide here, this is a web address for the IRS. So as I mentioned before, a lot of these things change from year to year. So it's important, and this is a really handy site. You go to the IRS website, and they're going to talk all about like individual retirement plans, employer-sponsored retirement plans, et cetera, and all the details for more information. But basically, and I'm going to run through these as well, specifically, you're going to have a number of different retirement plans that you might be accustomed to, you might have experienced in your work history. 401k, profit sharing, 403b, 457, SEP plans, simple plans, defined benefit plans. Let's talk about each one of these individually. So 401k is probably the most commonly known, right? So 401k is an account that typically you have at a for-profit company, right? So the employee gets to put money in, and they can put money in pre-tax, or Roth contributions are also available if the plan allows for it. And the cool thing about 401k Roth deferrals is that it doesn't matter how much money you make. So a regular Roth, you can't make over a certain income in order to contribute to a Roth. However, a 401k, it doesn't matter how much money you make, you can put money into a Roth, which is kind of cool. Employers get tax deductible contributions. That's if there's a match. So some 401k will have an employer match Some of them don't, but many of them do, which is kind of cool. And employers get a tax deduction for that amount. You can only put in up to a certain dollar amount per year. So right now, 2021, it's 19,500. If you're over age 50, you get an extra catch up of 6,500. Total maximum contribution dollars, 64,500. That includes both employee money and employer money, right? Many 401k plans offer loans, and loans are usually pretty cool. If an emergency pops up, many loans, depending on how your plan is written, you can borrow money with no interest. So that's kind of cool. Obviously, you're going to miss out on the growth because if you take the money out, you're not going to be subject to market volatility. So you're not going to be able to perhaps grow that because it will come out of the account. But oftentimes it's either a very low interest rate or no interest rate. So that's kind of an interesting thing. There are certain deadlines to establishing all retirement plans. So the deadline for a 401k is December 31st or the fiscal year end if it's prior to December 31st. Usually investments in a 401k are mutual funds. And they're also employee directed, meaning that if it's your 401k, you work for the company, you get to choose what you invest in, right? So that's typically the way that works. I think I mentioned yesterday that most people, in my view, and again, this isn't investment advice, but I'm just giving you my 20 plus years of experience trying to help you make more educated decisions, to be as successful as possible. In my view, mutual funds, are not that popular nowadays, except in a 401k plan where there's usually only mutual funds available. Profit sharing plans. So oftentimes profit sharing plans are in conjunction with a 401k. And profit sharing plans are only going to be employer contributions. So the employer adds something to the plan. And oftentimes an employer will use that as an incentive to, retain current employees and perhaps attract qualified new employees. 403b. So 403b is an account very similar to a 401k. But it's for typically nonprofit employees. A lot of school systems will have 403bs. So teachers will usually have 403bs. They're very similar to 401k. So you get tax deferred growth. You can do pre-tax contributions. You can also do Roth contributions. The limits are the same as a 401k. And many of the functions are the same. However, there are a couple of differences. You do have an additional catch-up. So if you're 15 plus years of service, in addition to being over age 50, you can put in some extra money as well. Typically 403b, I mean, it's not always, but usually it doesn't have an employer match. So usually it's just employee money, right? So that's something to keep in mind. And it used to be only annuities. So 403b plans used to be known as like a tax sheltered annuity plan, but that only had to be in annuities, but now that's not the case. And now it's the same as a 401k typically, and mutual fund based and driven by the employee. In other words, you choose the investments that you invest in. $457. 457 has a lot of numbers. 1, 2, 3, 4. 457 is another retirement employer-sponsored retirement plan, but it's a little bit different than 401k and 403b. It's usually for governmental employees. So if you work for a state, city government, usually you're going to have a 457. Your deferral maximum is a little bit lower, so you can't put in as much as a 401k or a 403b. But you do get some other cool things, like you have a special catch-up if you're 3 years prior to your normal retirement age. You have an additional $39,000 you can put in, which is kind of cool. And then you also typically don't have an early withdrawal penalty, right? So like 401k, 403b, if you take money out before you're 59 and a half years old, you would pay a 10% penalty. But at 457, you don't have that penalty. So that's kind of cool and that's unique. SEP plan, simplified employee pension is the name of it. Typically, SEP plans are for individual like one owner companies. they're going to follow the same rules as a traditional IRA, meaning that, you take the money out when you're 59 and a half. If you take the money out early, you're going to pay a penalty, that sort of thing. Your contributions are a little bit different. So your dollar value is a little bit different. Maximum this year is up to $58,000. You can invest in lots of different things in a SEP plan. You can do individual stocks, bonds, mutual funds, exchange traded funds. There are certain requirements. If an employer has a SEP plan, they have to cover all of the people in this group. So number one, if you're over age 21, if you worked at least 3 of the last 5 years, and if you have at least $650 in compensation, the employee must contribute to, contribute to the employees on their behalf. So usually SEP plans are only for like one person things. Let's say it's, one person that owns a company, doesn't have any employees. You can also do an owner 401k, but you can do a SEP plan, which will have less liability perhaps and less, fee structure is a little bit less expensive, a SEP plan versus a 401k. You don't have loans available typically with a SEP plan. Only 401k is going to have that, or 403b. So SEP is a little bit different in that regard. Simple plan. Simple is also a simple IRA plan, similar to a traditional IRA. The name stands for Savings Incentive Match Plan for Employees. It's going to be for 100 or fewer employees, right? So you can't have, it's not for big companies. The money will grow tax deferred, and then you pay tax when it's taken out, right? It's funded by both employees and employers. The maximum amount is $13,500. If you're over age 50, you get a little bit of a catch up as well. Again, you take withdrawals over age 59 and a half. All your retirement plans are going to be geared toward age 59 and a half. So come 59 and a half, you can take your money out. Simple is a little bit different. It's got the 10% penalty if you take your money out early, but it also increases to a 25% penalty if your withdrawal comes within the first 2 years of opening your account. So it's a little bit different. Again, there's going to be deadlines for all your plans. Investments, you can invest in a variety of different investments, including stocks, bonds, mutual funds, exchange traded funds, and you can't do loans. So just like a SEP plan, you can't borrow against it, right? Defined benefit. The defined benefit is kind of like a pension plan, right? AKA pension plan, AKA cash balance plan. It's funded solely by the employer. So not every company will offer, and in fact, they're not very common these days. And as time goes on, they're becoming less and less common. But they are funded completely by employers, right? Because they're funded by employers, investments are selected by the employer. So the employee does not direct and control the investments. Okay, so that's something that's quite different than 401k, 403b, the other plans that we talked about. Beneficiaries. It's important that you guys understand that all retirement accounts need to have a beneficiary. What is a beneficiary? That means that if you die, when you die, if you die, who's going to get your money? Who's going to get your account? It doesn't matter if you have a will. A lot of people don't realize that. People should have a will, a will and last will and testament, how your assets will be distributed. However, beneficiaries to a retirement account will supersede a will. What that means is, let's say you have a will and you leaving your money to your spouse, and then you get divorced and you have, an IRA and you're leaving your money to your new spouse, right? Whatever your beneficiary is for your retirement account, that will trump the will. So that's something that you might want to keep in mind. Now, some states, like let's say if you want to leave your account to someone other than a spouse, depending on where you live, you might have to have your spouse sign off on that. So in other words, some states have the requirement that if you have an IRA or a 401k or something like that, and you have a beneficiary of somebody who is not your spouse has to sign that they acknowledge that. That's an awkward conversation that I would not want to be a part of. We have kids accounts, right? So kids, how can we invest in for kids? We can have a variety of different things. We can have a custodial account. A 529 plan is common for like, that's a college plan, right? Coverdell. And last but not least, I want to make people aware of this. Kids can have Roth accounts. So Roth, I'm a big believer in not paying Uncle Sam too much money. I'll just put it that way, right? Like, we all pay taxes, but we want to minimize that. Like, I want to keep more of what I make, and I think we all share that same thought. I mean, you'd be crazy if you didn't share that thought, I think. So that said, it's kind of cool to invest in Roth accounts. So Roth, again, you put money in and that comes out tax free down the road. So it's kind of cool. Kids can have Roth accounts. So let's say like, you have a kid who's 15 and they don't have a regular job, but you pay them to shovel your snow or to do the dishes or clean the house or whatever. If they have some income, they can have a Roth account up to the certain limit that we went over before, which was, I think, $6,000 right now for 2021. So that's kind of a cool thing. Now, the cool thing about a kid, a 15-year-old having a Roth account is, oh my gosh, they're going to get like 40, 50 years of all that compounded growth and not pay any tax on any of it. Super, super cool. Let's move on to custodial accounts. Custodial accounts can be either UGMA, UGMA, or UTMA, UTMA. So it's either a Uniform Gift to Minors Act or a Uniform Transfer to Minors Act. They're pretty similar. Both of them have tax benefits. So the benefits tax-wise for custodial accounts is that you get the first $1,000 and not have to pay any income tax on it, $1,050 at the moment. The second $1,050 is tax at the child's rate, which is probably 0 as well. Or a very, very low rate, significantly lower than the parent rate. So that's kind of cool. If you take money out via a custodial account, anything that benefits the child is authorized. So again, a custodial account is it's like my name for the benefit of, a minor. So ultimately that money is to be used for the benefit of the minor. You can invest in lots of different things. You're not limited really, stocks, bonds, mutual funds, ETFs, lots of different things. The one difference in custodial accounts, whether you have an UGMA account or an UTMA account, is the age of majority. When it's dictated that the child has access, full access to that account. With a Uniform Gift to Minors Act, with an UGMA account, UGMA account, the age of majority is 18, whereas in the UTMA, age of majority is 25. So it's a little bit different. $529 plans. 529 plans are kind of cool because they give you tax-free growth if you use the money for college, right? And you don't have to only use it for tuition. You can also use it for like books and dorm expenses, that kind of thing. If you don't use it for college, though, you are penalized, and you do also have to pay tax. So you get the tax-free growth if you use it for eligible college expenses. It's state specific, so depending on where you live, you might have a California 529 plan, a Connecticut 529 plan. There's different tax benefits depending on those plans. And typically the investments are mutual funds. So that's, in my view, that's a downfall to 529 plans. I'm not a big fan of mutual funds. I said before, yesterday, I said that, most mutual funds, probably 97%, do not outperform their benchmark, meaning that you end up paying fees associated with the mutual fund, and the manager of that fund is not doing any better than what he's pegging the performance against, right? So you end up paying, you get a drag on your performance, you make less money ultimately. So that's a disadvantage in my view for 529 plans, but the advantage is the tax-free growth if you use it for college expenses, and colleges are super, super expensive. What are they, 50K a year, something like that, plus or minus. And tuition, college expenses, inflation typically goes up like at an average rate of 3% per year. What that means is, the cost of goods and services like increases by on average 3%. So, the cost of my lipstick here is going to be 3% more next year, typically on average. However, college expenses have been increasing at astronomical rates, typically 6-7%. Coverdell ESA, Education Savings Account. What is that? It's kind of like a 529 plan, but it also includes qualified K through 12 expenses. So sometimes, you might have a kid that goes to private school, so you're going to have some coverage, some advantages from a Coverdell ESA. That's going to be different than a 529 plan. It does have lower contribution limits than a 529 plan, and it's only available to families below a specified income limit. So not everybody can participate in a Coverdell ESA or Education Savings Account. Something to keep in mind. So that kind of wraps up the types of investments. I know I ran through that kind of quickly. Non-retirement accounts, retirement accounts, the takeaway being, always look up those limits at the IRS website, because they do change from year to year. I want to go over a couple of other pieces of information as we wrap up today's session. Again, this is only a 2-hour session. So if you want more information on any of the content that we talked about, please hit me up. Let me know via, social media, text, email, whatever. And I have other courses available as well. Lots of free stuff, some paid stuff that dive a little bit deeper into all this. So let's talk about where can I go to open an account, right? So some people might be saying, okay, Michelle, that's great, but where do I go from here, right? How does that work? So where you go to open an account is at typically a custodian, right? So custodian, also known as a broker dealer. And, you want to be cognizant of the fee structure. Are you going to pay fees as you go along, or are you going to pay commissions on trades that you make? So that's an important distinction that you want to ask whoever it is that you're working with, if you're working with a financial advisor, or if you're typically, if you open an account on your own, typically that's going to be commission based. If you open an account, let's say at Robinhood. Robinhood is kind of like a new cool thing. And as I said yesterday, don't take any of this as financial advice, number one. And number two, I'm not incentivized, I'm not recommending any of these companies. I'm just giving you ideas and examples to help you make smarter decisions and to help you understand a little bit better. But Robinhood is kind of a cool thing where, you can buy, one share of this or one share of that. And often there are either no fees or low fees. Single or open architecture. So some platforms, offer you the ability to invest just in one thing. Like, let's say if you went to a mutual fund company, American funds, you can only typically invest in American funds, or can you invest in open architecture, lots of other things. I'm a big believer of variety and having a lot of choices. Some common custodians: Fidelity, Vanguard, Edward Jones is where I started way back when, a bunch of years ago. Again, I'm not recommending any of them. A downfall to some of these, like for example, Edward Jones, they have a platform that's both fee-based and commission-based. So sometimes, the financial advisor will be incentivized by recommending one thing over another thing. So typically, sometimes when you have, commissions like that, and an incentive to recommend one thing over another, you don't typically have as much of a, maybe they might be more apt to recommend one thing, even though it might not be in your best interest. I'm not necessarily saying that that's what they do, but that's a possibility. So something you want to keep in mind. You want to consider a number of things when it comes to custodians. You want to consider cost. How much, is it going to take, to put a trade through? How much is it? Are you going to pay to buy a stock or something like that? You also want to consider SIPC. What is SIPC? SIPC. SIPC insurance is very similar to FDIC insurance. I think yesterday we talked about FDIC insurance. So that is insurance in case the company goes bankrupt, right? So if you're doing business with somebody and they go insolvent, they go out of business, they go bankrupt, SIPC insurance will make sure that you don't lose all your money. Now, there's going to be limits, just like FDIC, like we talked about yesterday. So you want to double check what those limits are. So you want to have that as a consideration. You also want to have as a consideration the trading platform. Some platforms are easier to understand than others. Some platforms are only geared toward Windows computers, and you can't put it on a Mac, let's say. That might be important. Me, I'm a Mac person, right? So maybe that's important to you. How much education do they offer? Do they help support their customers? How is their support department? Is it easy to get through and ring them if you have questions, that kind of thing. So that's something that you want to keep track of. Chapter 5, this presentation is really geared toward giving like a lot of, initial foundational information to people that don't have any experience in investing. However, it's also good for if you do have a lot of experience, and I want to deliver stuff that you probably didn't know that you are going to consider of value. So here's a cool thing. Now, I have a presentation, a free one actually, that I've done on online that talks specifically about this, where the big money invests. A lot of people, I'm so surprised on how many people don't know this, right? Big investors, controlling shareholders of publicly traded companies, people that have big blocks of shares of a publicly traded company, people like Warren Buffett, we'll say like that. They are required to disclose when they buy or sell stock. Now, it's very specific. They have to disclose it through the SEC, the Securities Exchange Commission, and they have to disclose it within 48 hours. So you can go to this Edgar Online, SEC Edgar Online. It's the web address is right here, and you can look up, Apple stock, and you can look up the forms filed for Apple stock. Was there, did Warren Buffett or did Jane Doe or John Smith or whoever buy a bunch of Apple stock? How much did they buy? Did they sell a bunch of Apple stock? That's important. Why is that important? Let me tell you why it's important. First of all, I come from the investment world, right? And I was, did it for myself for many, many years. And I did it professionally for many, many years as well. And over that time frame, I've seen a lot of different things. And I can tell you that there's some shadiness involved in the investment industry. Sometimes the deck is stacked, so to say. So the regular investor has to do and has to, participate in as many of these cool things as possible. So that's why it's crazy to me that a lot of people don't know that. If you own stock, if you have a stock portfolio, you have a Fidelity account and you own a bunch of stock, you have a little bit of Amazon, a little bit of Tesla, a little bit of Google, whatever, right? Wouldn't you want to know if some big investor, some whale goes in and sells like, $5 million worth of that stock? Yeah, you should want to know, because here's what affects stock prices. If somebody comes in and sells a bunch of stock, that's going to drive the price down typically. Somebody comes in and buys a bunch of stock, that's going to drive the price up. You can ride on their coattails. Again, it's kind of like, I think actually, who said this? Maybe it was Warren Buffett said a long time ago, like, it's easier to be a small investor than it is to be a big investor. And he was talking about stuff like this. So you can go online. It's totally free. You can look that up. I have another presentation that goes over more details on that. I also, this is the highlight of my career, created an app not long ago. I have an app through Apple as well as Google Play. If you have an Android, there's a free version and there's a paid version on delivering that data to you. So the advantage of having an app is kind of like, you could just see that, on your phone right here. And then the paid version has the, will send you push notifications each time. Like, let's say, you put a watch list together of your favorite stocks, and each time an insider buys or trades stocks, buys or sells that particular stock, you're going to get a push notification. That's kind of a cool thing. So those are the hyperlinks there as well. Another important thing that you need to know is dollar cost averaging. DCA, it's like so old school, and I get like flabbergasted when I talk to people that don't know what that is or how that works. When you dollar cost average, now you can do this with stocks, you can do this with Bitcoin. Oh my gosh, it's super cool. Again, I have a couple of other sessions, lots of them are free. So if you want more information, hit me up. But basically what that allows you to do is that you're buying more shares when the price is lower, and you're buying fewer shares when the price is higher. So it's a very good strategy. It also helps remove the emotion from investing. So emotion is one of those things that really kind of like trips people up, right? So it's very important. Like, we invest money, right? So a lot of times we are emotional about our money, but we want to try to not be emotional when it comes to investing, because you want to make decisions from a state of clarity, of grounding, of that sort of thing. So when you dollar cost average and you say, okay, every month, on the first of every month, I am going to buy $100 of Google stock. And on the 15th of every month, I'm going to buy, $50 of Bitcoin or whatever that case might be. You're taking all the emotion out. So it's kind of a cool strategy.